Welcome to the final video in our Series 6 of video tutorials on technical analysis. In this video, we will be discussing how to use market gaps while trading. We've often observed market gaps in one or the other price charts. A market gap is an area on the price chart in which there were no trades performed. Normally, this occurs between the close of the market on one trading day and the open on the next trading day. These could also be observed intraday during a sudden price move. The market gaps are classified into the following types. We have the common gaps, the exhaustion gaps, runaway gaps, and breakaway gaps. Before we get into understanding each one of them in details, we first discuss what causes these gaps. There are a lot of things that can cause the markets to gap up or down, such as an increased enthusiasm or fading interest concerning the financial instrument in consideration, a major economic event or a news release during the time between one day's close and the next day's open, a natural disaster in some part of the world, or for geopolitical reasons such as the unrest in some countries. So we begin with the first and the most common market gap, which also goes by the same name, the common gaps. These gaps are often considered as an uneventful one and are mostly restricted to a particular financial instrument only. These gaps are usually formed as a result of price consolidation or the lack of interest in trading the underlying financial instrument. The gap formation is mostly followed by the price retracement back towards the starting point of the gap. This is referred to as the gap being filled or closed. This provides traders with the opportunity to trade the financial instrument in the direction of the price retracement. Next, we have the exhaustion gap. Unlike the common gaps, these gaps are quite eventful and interesting to trade. Though formed in the direction of the ongoing trend, these gaps mark the potential end of the trend and are indicative of the trend reversal. The volume associated with the price move before the gap formation flattens, and then once the gap emerges, there is a sudden spike or increase in the trade volume associated with the price move after the formation of the gap. Just like the common gap, exhaustion gaps also mostly get filled as a result of price retracement in the direction opposite to that of the ongoing trend. So if the gap was formed during the upward price move, it will be filled by the retracement towards lower price levels, indicative of selling the underlying instrument, which is considered as a trading opportunity. The gap is considered to have been closed or filled once the price retraces completely up to the starting point of the gap. Next, we have the runaway gaps. The runaway gaps, as the name suggests, are created as a result of the price running in the direction of the ongoing trend. This results from a sudden increase in the demand of the underlying financial instrument. For example, a major policy announcement made by the ECB could cause the euro-dollar to exhibit this gap due to its increased demand and panic. The increased willingness of the traders to enter into the trade, irrespective of the price level they enter at, is one of the major reasons for the creation of these gaps. This can be observed from the trade volume associated with the underlying instrument before and after the formation of the gap, which is found to be significantly high. The price move following the gap formation is in the direction in which the gap has been formed. So since there is no price retracement, these runaway gaps do not get filled. Finally, we have the breakaway gaps. Again, as the name suggests, these gaps are formed as a result of the price breaking away from an area of price congestion or price consolidation. The congestion area could act as either an overhead resistance or an underlying support, which would determine the direction of the gap formation. If the congestion area is around a support level, then following the breakout of the support, the gap will be formed in the downward direction. Alternatively, if the congestion area is around the resistance level, then following the breakout of the resistance, the gap will be formed in the upward direction. These gaps are indicative of the market enthusiasm and the sentiment towards selling or buying the underlying instrument. This can be observed through the associated trade volume, which after the formation of the gap is found to be significantly high. Since the price is expected to continue moving in the direction of the gap formation, thus a price retracement is not expected and these gaps do not get filled. Now that we know the various types of market gaps that can be identified, we shall see how to use them while trading. For gaps that are filled or closed following a price retracement, such as the common gaps and the exhaustion gaps, one should try and place the trade in the direction of the price retracement. So let's say for a common gap that was identified in an upward price move, the gap will be filled by a price retracement in the downward direction towards the starting point of the gap. So a trader might sell at the end point of the gap and set his profit target at the price level close to the starting point. As the gap gets filled, his trade would be complete as well. For the gaps that do not get filled, such as the runaway and breakaway gaps, one should try and place the trades in the direction of the gap formation at the price levels close to the end of the gap. So for instance, if the gap was formed in a downtrend, then one should look to sell the underlying instrument close to the end point of the gap. The main objective here is to continue trading in the direction of the gap formation. Few important things to keep in mind while trading these market gaps is that one should not hold on to their trade positions for too long. This holds good especially for the gaps which do not get filled. That is the runaway and breakaway gaps. More importantly, any pending order that has been placed prior to a gap formation will be filled at the best available market price available following the gap. This can often result in the pending orders being filled at a price very different from the requested price level. And as always, it is essential to use stop loss while trading the market gaps. With this, we come to the end of this tutorial as well as our series 6 on technical analysis. Thank you for watching.